Hey, good afternoon, traders. Jeremy here, and wanting to post our weekly market recap. So we're looking at the SPY ETF right now. Uh, this I'm going to classify basically as neutral. Right now we're in short-term downtrend, obviously still below the diagonal channel here that is acting as resistance. We closed the week this previous week basically right at a very important cluster of moving averages here. The 9, the 20, and the 50 period moving average are basically right at the closing price from this last week. So if we want to get more bullish, we have to see it basically clear that cluster. I'm going to say clearing the diagonal resistance channel here somewhere above 402.5 probably would be the line in the sand, which is the high of this previous last week's candle on the weekly chart. If we scoot into a daily chart, I'll show you in a second, it does look maybe like we will have a slight bullish lean to start the week, but the MACD on the weekly chart here is still showing bearish. We really need to see this stay above the zero line there, which at this point, it looks like it's trying to do. So it's going to be really important to see how the price fights for this resistance line to kind of reclaim that 400 to 402.5 zone. If we drop into the daily chart, the MACD is actually curled higher and is trying to fight to move higher. We are still below the 50 period moving average and again this diagonal resistance line, so it's hard to get too bullish until we break out of that. And on top of that, with all of the news that we had this last week with the Federal Reserve and another 25 basis point increase and all of the issues that our economy is facing with our banking system right now, it's kind of hard to paint a bullish picture. That said, like I said, I wouldn't be surprised to see price action come back up and maybe test this 400 to 402 arena. Probably get slapped down by that is my guess and consolidate underneath this for the rest of the week. I am guessing that we are probably not going to see a major move to the upside this week. I'm kind of anticipating a little more consolidation under this resistance channel. If we could close up into that 400 level, it might set us up for another move higher next week, but for any bullish triggers, I am waiting for this to clear the diagonal resistance there. To the downside, we do actually see there is a widening volatility here, so there's only a little bit of space between the channel here, and then obviously a much greater distance between the channel here. So that basically just shows that there is increasing volatility in the market, which we saw in the VIX. And the VIX did settle down quite a bit. So for anyone not familiar with the VIX, another crash course, anything below 20 is considered low volatility. Anything above 30 is considered extreme volatility. And then in the middle, it's just kind of a gray area. We would like to see this continue to settle down and pull down back towards this 20 arena. Depending on the news that we get this coming week, I mean, we have been seeing massive, massive moves. These are gigantic candles on the VIX. Look at any of these candles from the last 2 weeks and compare them to the norm over the last 6 months, and you can see what I mean. So until that volatility settles out, it's really hard to have a strong conviction for either bulls or bears. So oftentimes patience is key, waiting for those really good setups and trying to target very specific areas of the market that show either strength or weakness, depending on if you're going bullish or bearish. So right now, the VIX, I would like to see these big candles settle out, even though it settled to the lower end of its channel here at the end of this last week. It still did have these big wicks on both sides, which tells me that there's still a lot of indecision in the market, and it's going to be hard to have much conviction one way or the other. So going back to the SPY really quick, we're seeing that indecision here with the big wicks and the VIX show up as these bigger swings within the marketplace in the price action. Really nothing would surprise me all the way down to 380 or all the way up to breaking out above the 402.50 zone. Those are kind of the lines in the sand that I am looking at right now as being the lines for bulls above that 402.5, or for the bears below this 380 mark. Anything in between, I'm probably going to be cash flowing via options and low risk strategies. And again, just waiting for this to pan out a little bit more. So I do have to say that on the weekly chart, even though the MACD is showing a slight retracement sign still, I like the overall formation of this. We did actually set a slightly higher pivot low right here compared to the previous week. So it is building some support here. We want to see that hold, and we want to see it break out above the diagonal channel. Now, if we go to the Dow Jones, our next market index, this is basically neutral to me. It's chopped in a range here for quite a while. It did just break down from a pretty significant support level, and it kind of hit its head on that now. So if I was forced to choose, I would say this probably has a little bit more pain in store, likely to come back down to the 310 arena, down to the 200 period moving average. But I'm not really anticipating a violent move one way or the other on this. I think that money has been cycling out of the Dow Jones over the last couple of months here, ever since basically the first of the year. Money has slowly been pulling out of it, and I don't see that stopping. I'm seeing this more as a bearish retracement with probably some more consolidation leading to a slight bearish edge. Next, if we go to the triple Qs, the NASDAQ, this is the area of the market that I have the most interested in directionally trading right now. You can see that we had the double bottom back here last year. We had the W formation right here that broke out to the upside, came back and retested a little bit deeper than I would like, but it held its moving averages. And now we are back above that, and we are now testing the highs here. Two things could happen from this point. We either have a double top where it comes up into that resistance channel, fails, and then comes back down, or we have some consolidation here and a breakout and another run, probably up to the pivot highs from this previous week around 335. So if you are playing the NASDAQ index or any of the big tech companies that are held within the NASDAQ, it's going to be important to have this resistance level break before you take action on that. You can see that more clearly right here. Let's get a better number. About 315.25 is the resistance. So we want to see a close above that to signal that the bulls are back in control. The MACD did set a higher pivot low here, and the MACD on the daily chart is showing bullish. So some consolidation here underneath that breakout range with an attempt to break higher does make some sense to me. If we drop this back out to the weekly chart, the MACD is actually still confirming and is actually widening a little bit its signal line on the weekly as well. And that's going to be on the back of companies like Apple from this last week, had a really good, strong move for the week, as did Microsoft. We had this nice big blast up, pullback retracement confirming, and this one's actually looking like it wants to break out and potentially run. So Microsoft might be a targeted approach for this week ahead. Also, companies like Google. Google had a really nice run. I mean, it is up, what is that? 18% basically from the lows in the last 2 weeks. That is a massive, massive move in just 2 weeks for Google. I wouldn't be surprised to see some consolidation and time off in these companies that have run hard, followed by a continuation higher. And that feeds into the base case that I was talking about some consolidation in the Qs. It's hard to think that the NASDAQ is going to break out and run hard when most of the major components, Microsoft, Google, Amazon, Facebook, Apple, when all of those are a bit overextended. So we probably need to see some consolidation in those big names before it resets those chart patterns and gives us the ability to try to break higher on the NASDAQ. And finally, if we go to the Russell 2000, IWM, this chart looks ugly to me. If we drop this out to a weekly chart, you can see we broke down with vigor through all of the moving averages. We broke the diagonal support line here. We are now looking to probably come back and test the 160 to 162 area, which was the support from the double bottom back in mid last year. The MACD signal lines are crossing bearish on the weekly chart, and I don't see that being done yet. So a retest of this 160 to 162 zone does make some sense. If we drop this back to the daily chart, we had a little bit of a try to reprieve. We got back briefly above the 9 EMA and quickly lost that again. And it's just been kind of a volatile mess. Obviously, IWM, the Russell 2000 ETF, is highly impacted by everything going on with the regional banks and bank failures that we've been having, and just the general concern about the banking industry stability currently in the marketplace. This is the area that houses most of those stocks, so it is obviously most exposed to that downside risk. And I'm kind of expecting just a lot of volatility and chop in here, with it eventually coming down to test that 162 level. Hopefully we will get a good tradable signal there, some kind of consolidation before a break higher that we might be able to play once we're on the other side of this, but that's probably at least a few weeks away for me. Next, if we drop in and look at our sectors, this marketplace is going to be a market where you are going to want to be really focused on finding the strength in the marketplace and staying away from the weakness. So a good way to do that is sorting your watch lists by RSI. This is the relative strength index. And basically anything above like 45 to 50 is considered strength. Anything below that level is considered more weak. So if we sort this, silver actually is showing a lot of strength right now, but it is overextended to the upside. I like gold a bit more just because there's a little bit more of a theme behind gold in the marketplace right now. And GDX still has some catch up to do here relative to the actual gold instrument itself. It is a little overextended on the weekly chart right now. I wouldn't mind a little bit of a consolidation this week, followed by a press higher in future weeks. But any pullback in gold right now, I think, has to be looked at. Anything that pulls back down into the 180 to probably 175 on the deeper end. I don't want to see it go much deeper than that, but hopefully consolidation around this 180 mark would lead me to buy more and go directionally long if a good chart pattern develops right there. Next up in terms of strength is tech. Obviously, technology ETF is going to track very similarly to the NASDAQ. It has a very nice consolidation pattern here, did close above that technically at the end of this last week. Its MACD is showing that it might have some room to run still. And if we kick this bad boy out to a weekly chart, it looks basically identical to the NASDAQ. So again, targeting up to the previous highs here, probably around 150 as a target one, and then potentially pressing a little bit higher, maybe up into the 158, 159 arena there. I like the support level. I like that this increasing volatility right here, where each candle got successively bigger, has now resolved to the upside. That tells me that it wants to go higher. We also had a nice pop in volume for the weekly volume on that last green candle there. So this tells me that really money is trying to rotate into areas of the market that have maybe been beaten down in previous months, and tech looks good here for a little while. Next up, communications. Pretty much the same story, honestly. We had a nice retrace, tested and held support down here at previous support level, confirmed off that, closed with a pivot, confirming this pivot low as a higher pivot low previous to these other two. The MACD is showing good. We have good relative strength on the RSI. And if we drop that back down to a daily chart, you can see that it confirmed off of its 200 period moving averages, and all of its moving averages here are now stacked, curled up, and acting as support underneath it here. So I do like a potential trade to the upside, targeting back up to maybe this 60 level with a breakout that clears the wicks of these two previous candles around 57.15. Next, if we just rapid fire through the rest of these indexes, I'm just going to go out to the weekly chart for them. Consumer staples underneath the cluster of moving averages, it's going to have a lot of work to do to get back above those. If it does happen to get back above those moving averages, I will like it more, but it probably has a week or two that it is going to need to consolidate and fight for that. MACD is still showing slightly bearish, although it is starting to show a bottom pattern there. Going out to our healthcare system, anything here has to be looked at as probably a bearish retracement. My base case is neutral to slightly bearish. XLU looks bearish to me. Consumer discretionary, I do like the slightly higher pivot low here. We do have a lot of overhead resistance, so I would need it to get back up above the 200 period moving average here at about 151 before I'm going to be much interested in that. Unfortunately, that's a big enough move for it that it'll probably be overextended by the time it gets there. So we're probably a couple of weeks out here because we need to see a little bit more consolidation on that if it is going to recover and start moving higher again. I do like the fact that we have kind of a head and shoulders pattern here with the left shoulder, the head, and then the right shoulder here. So a break above that 151 area would be technical completion of that head and shoulders, which is a known bottoming pattern and would lead us to believe that there is higher prices in sight after that. Again, it needs some time to develop. Going out to builders, not much to see here. It's trapped between its cluster moving averages on top and the all-important 200 period moving average on the bottom. This looks neutral to me to slightly bearish. XLI fighting to get back above its 50, still underneath its 9 and 20 moving averages. Again, neutral, nothing really to see here. USO breaking down, potentially lower prices coming. Same thing with XLE. XLE has just broken and closed below its diagonal resistance line that goes back to the end of last year. Usually when that happens, you'll see one last little pop up to fight, likely coming into this old resistance zone and then a rollover from there. So I am staying away from this area completely until I see more formation. But my base case has to be lower. MACD is lower. Weak RSI showing that compared to the rest of the market, this does not have much bullish strength in the chart. All of this is looking like lower prices ahead for XLE. Same thing for our real estate ETF here. It is overextended to the downside, though it has a very weak RSI and the MACD is rolling over and turning bearish on the weekly chart. Just for kicks, let's toss this one into the daily chart. We are still below, obviously, the diagonal resistance here. I am not interested in bottom fishing this at all until we get back above the 20 period moving average. This has been a very consistent push down. The 9 EMA here shown in green has just been very consistent, holding as upper price limit for this for quite some time now. And even if we do get a slight pop, I would anticipate we would probably have it recede back down and give us some kind of a double bottom or some kind of other bottoming pattern to signal that it was actually ready to go higher again. This is also going to be really hard because real estate trails the rest of the market economically most of the time. And I think we are just starting to see more of the damage happening in the real estate market with prices starting to deteriorate. So I don't see a trade here anytime soon. It's going to need quite a while, probably another month or so if I had to guess, before there's going to be a good bottoming pattern that I'm going to be even slightly interested in. And finally, going out to XLF. So this is our financial ETF tracking all of those poor banks that have just been getting beat up behind the woodshed this week. It did just break its 200 period moving average, and it is actually fighting right at the same support level that we had going back 9 or almost 10 months ago now. Massive move to the downside. It is technically overextended to the downside, just on a sheer price basis, but I am not touching this. If anything, I see a little bit of a reprieve bounce and then a rollover again because we are not out of the woods with the banking issues that face most of the regional banks that are all contained in this XLF ETF. So lastly, let's just look at a couple market internals. Again, the VIX. I would love to see this settle down and to have a couple of days at least of small bodied contained candles here without these giant ranges. So before I get too bullish on anything, including tech, I'm going to be waiting personally to see a little bit of this volatility settle down and to have that kind of flush out of the market. On our advanced decliners index, we did have a little bit of a rally coming into the end of the week. This last green bar here shows that most stocks did end favorably on Friday compared to where they opened. So there was a little bit of a reprieve bounce. You can never put too much faith in one day's movement. Instead, I like to look at the moving averages and specifically the 20 period moving average in relation to this zero line. And the 20 period moving average is still under the zero line. telling me that bears still have a slight edge. Finally, going to our AR high-low indicator. Again, closes above positive 50, 2 in a row, signal bulls in charge, closes below 50, 2 in a row, signal bears in charge. This is our second day on the daily chart here, closing below that 50 mark, signaling that bears probably have a slight upper edge. And although the 20-period moving average is curled up and closing the gap towards that zero line again, it is still well below that zero neutral line. So again, has to favor slight edge to the bears. I hope that helps, guys. Trade safe. Take care. Let me know in the comments if you have any questions or want me to expand on anything. But short version is we need some consolidation. We need the themes specifically around banks and inflation to work themselves out a little bit more before we have a very concrete trading thesis. Aside from that, the lean has to be slightly bearish on most areas of the market, other than the exceptions being gold, communications, and tech. Those three areas of the market are going to be the places that we are probably going to see continued strength and money rotating into it in kind of a flight to safety. So if you are wanting to play the bullish side of the equation, looking in gold, tech, and communications for pullbacks to play is going to be the route that I take. Hope that helps, guys. Take care. Trade safe. Bye.